All right, strap in, everybody, because today we are going deep on this whole capital cycle thing.
Ooh, exciting.
You know, like how do companies actually grow?
Right.
And sometimes you see them making decisions and you're just like, what are you doing?
Yeah.
It seems so irrational, but we're going to learn how those decisions can actually point us towards some really amazing investment opportunities.
That's right. And the cool thing is we have this collection of reports from Marathon Asset Management.
Oh.
And these folks, they've built their entire strategy around understanding this capital cycle.
Okay.
So they've been studying this for decades, and their insights, let me tell you, they're pure gold.
So capital cycle, it sounds a little bit like Econ 101.
Yeah.
Can we like break it down, you know,
Of course.
make it so it doesn't feel like we're back in school.
Absolutely.
Yeah.
Think of it as a heartbeat, but for an entire industry.
Right.
There's this constant pulse of investment.
Right.
It flows in, then it dries up, then it flows back in again. And Marathon, they use this great example. They talk about a widget maker, you know,
Yeah.
I just call them macro industries.
Sure.
And the CEO, this ambitious guy, we'll call him William Lewis Hard.
Okay. I like it. I like it. Sounds very distinguished. Yeah.
It does.
So our widget company, they're doing great.
Right.
Profits are up. Everyone's happy.
Yes.
What happens next in this cycle?
So those juicy profits, they attract new investors.
Mm-hmm.
Capital, everybody wants a piece of the pie, right?
Like bees to honey.
Exactly.
Yeah.
So this leads to a surge in investment.
Okay.
Companies expand. You got more and more widgets being produced.
I'm already seeing where this is going.
Okay, what do you think happens?
I feel like there's going to be a but coming.
Yes, there is a but.
Okay.
Eventually, all that investment leads to way too many widgets.
Oh, no.
Demand can't keep up, prices drop, and suddenly those amazing profits, PFT, they start to dwindle.
They go away.
They go away.
Yeah.
Investors, they head for the hills. Companies scale back. Things get tough for a while.
Right.
But eventually, after some of that consolidation, the industry recovers and the cycle starts anew.
So it's like this natural boom and bust, boom and bust, boom and bust.
Exactly.
But here's what I don't get.
Okay.
If everyone knows this pattern,
Right.
how come these companies, often led by some very, very smart people,
Yeah.
how do they keep falling into this trap of over-investing? You know?
That's where the human psychology comes in, right?
Right?
You got all these brilliant minds, but Marathon talks about things like competition neglect.
Competition neglect.
Yes!
What is that?
It's fascinating. It's like CEOs put on blinders and pretend their rivals don't exist.
Oh, wow.
They get so focused on their own growth plans and projections
Right.
that they totally fail to see that everyone else is doing the same thing.
So they all think they're going to like corner the market. Everyone else is just going to fall by the wayside.
Exactly. They're all expanding at the same time, assuming they'll grab, you know, the lion's share.
Right. So they're all in this bubble
Yes.
of optimism.
Yes.
Got any like real world examples of this?
Oh, plenty. Look at the telecoms bubble back in the late 90s.
Oh, yeah.
Companies were laying down miles and miles of fiber optic cable,
Right.
so-called dark fiber.
Dark fiber.
Based on these wild predictions of internet traffic.
Right.
But they all did it at the same time.
At the same time.
Completely neglecting to think what happens when everyone has this massive capacity.
Right. And boom, the bubble bursts.
Bubble bursts.
Okay.
That's right.
What about this inside view thing?
Oh, yeah, the inside view, that's another bias.
Okay.
It's this tendency to get so focused on your own company's data
Right.
and your own experience that you miss the bigger picture.
Okay.
You're so deep in the weeds, you can't see the forest for the trees.
Yeah.
It's like planning a road trip based on like your fastest ever time, but without considering traffic or weather.
Right. You're just going off of like your ideal scenario.
Exactly.
Okay. So they're driving with blinders on.
Blinders on.
Just in the rear view mirror instead of looking ahead.
Yeah.
But surely companies learn from these mistakes, right?
Yeah.
Like,
Yeah.
why do we keep seeing this cycle repeating over and over and over again?
Well, we can't forget about our friends on Wall Street.
Oh, here we go.
They have a vested interest in keeping this capital cycle spinning.
Yeah.
And let's just say they're very good at their jobs.
Oh, they're the ones that are like
They're the ones
fanning the flames.
just fanning on the flame.
They're the whole thing.
Think of them as like the master conductors of the orchestra,
Okay.
right? They encourage companies to invest and grow, often pushing them to take on more debt or issue new stock.
Right.
It's all about keeping the deals flowing
Right.
and the fees rolling in,
Fees.
even if it's not always in the best long-term interest of the company or the shareholders.
So in the boom times, they're the cheerleader.
They're the cheerleaders.
What about when the bust hits?
What happens then?
Yeah.
They become more like undertakers. They come in and they help restructure debt,
Okay.
consolidate industries, essentially cleaning up the mess.
Interesting.
Yeah.
Interesting analogy.
Yeah.
But how does understanding this whole capital cycle thing
Right.
actually help us? Like regular investors,
Yeah.
not these high-flying Wall Street guys.
Sure.
It just seems so chaotic and unpredictable.
That's the beauty of it.
Really?
Once you see the pattern, you can start to anticipate the moves
Okay.
and find opportunities where others see only risk.
Okay.
Marathon's approach is to look for value in the wreckage.
Okay, so like
I'm an archaeologist.
they're sifting through the rubble after the bust, looking for like hidden gems.
Exactly. They look for industries that are consolidating, where the weaker players have been shaken out,
I love it.
capacity is shrinking. A fascinating example they cite is the Spanish construction boom and bust back in the early 2000s.
Spain, wasn't that a pretty disastrous situation?
Oh, it was. Property prices soared.
Right.
Fueled by easy credit, leading to this massive building spree.
That's familiar.
Yeah, it does. A lot like what happened in the U.S. housing market.
But right.
Very similar dynamics. But here's the thing.
Okay.
For investors who understood the capital cycle,
Yeah.
that bust created incredible opportunities.
They're
As
lucky.
the dust settled, they could swoop in,
Okay.
buy assets at bargain prices,
Wow.
knowing that eventually the market would recover.
So it's all about like
Patience.
recognizing those turning points
Yeah,
and having the guts to go against the crowd.
exactly.
Okay, do they have any like specific company examples
Yeah.
that show how this works in practice?
They do. One of their most impressive investments was in a Finnish financial company called Sampo.
Sampo.
And their CEO, Bjorn Walrus, he was like a chess grandmaster when it came to capital allocation.
Oh, wow.
He made some bold moves, selling assets at the peak of the market
Okay.
and consolidating the Nordic insurance industry.
It sounds like he really understood the timing of that cycle.
He did.
Yeah.
He understood it well.
Okay, any examples on the flip side?
Oh, yeah.
Companies that like totally missed the boat on this whole capital cycle thing?
There are plenty of cautionary tales. A stark contrast to Sampo is the story of Anglo-Irish Bank.
Okay.
They were like the poster child for what not to do
Okay.
during the Irish property boom.
Yeah.
They were lending money like it was going out of style,
Oh, yeah.
fueling the frenzy with risky loans.
Didn't that almost like bring down the entire Irish economy?
It came dangerously close.
Wow.
Their loan book was overflowing with bad bets tied to property.
Yeah.
When the bubble burst, they were left holding a mountain of debt
Wow.
and needed a massive government bailout.
That's a lesson learned the hard way.
A hard...
Okay, so we've seen a winner, we've seen a loser.
Yes.
Any other examples that really drive home this power of the capital cycle?
Vestas Wind Systems, a Danish company that makes wind turbines.
Okay.
It's a great case study. They went from being a hot growth stock
Really?
to a beaten down value play and back again in just a few years.
Oh, wow. So they rode the wave up and then down.
Yeah.
So how does that illustrate the capital cycle?
Because it shows how quickly sentiment can shift
Mm-hmm.
and how understanding those underlying dynamics
Yeah.
can help you spot opportunities that others miss.
Okay.
So when everyone was piling into Vestas as the next big thing,
Right.
Marathon recognized that the industry was getting overheated
Okay.
and that a correction was likely.
Right.
They sold their shares, avoiding the crash,
Wow.
and then bought back in at a much lower price when the dust settled.
Oh, very smart.
Yeah.
Okay, I'm starting to see how this all kind of fits together.
Yeah.
But something that keeps popping up is this emphasis on management.
Management, yes.
It seems like Marathon puts a lot of weight on finding companies with the right people at the helm.
Absolutely. One of their core beliefs
Okay.
is that even in a favorable industry,
Right.
poor management can just squander opportunities
And destroy value.
and destroy value.
Yeah.
Completely.
So it's not enough to just pick the right industry.
Right.
You need the right captain steering the ship.
Exactly.
Okay.
So they're looking for management teams that can steer that ship through rough waters.
Mm-hmm.
You know, resist the urge to overspend when times are good
Right.
and make the tough decisions when things get tight.
So they're like the Navy SEALs of the corporate world.
Yes, that's a good way to put it.
Yeah.
They have to have that discipline.
But how do you actually spot these, like, exceptional leaders?
Right.
Is there like a secret formula?
There's no magic formula, but there are some patterns they look for.
Okay.
For example, they really like companies where management has a lot of skin in the game.
Skin in the game, meaning?
Meaning they own a big chunk of the company themselves.
Right. So their interests are aligned with the shareholders.
Exactly. Their wealth is tied to the company's success.
Makes sense.
So they're going to think like owners, not just hired hands.
Okay.
Marathon also scrutinizes executive compensation,
Oh, interesting.
looking for red flags like excessive pay packages and perks.
Oh,
They want CEOs who are focused on building that long-term value,
Right.
not just enriching themselves.
right.
So it's about humility
Mhm.
and a genuine commitment to the company's mission.
Okay, I like that.
Yeah.
So they're not just looking at like the bottom line.
Yeah.
They're looking at the bigger picture.
The bigger picture.
Yeah.
They're also drawn to companies with a culture of frugality,
Frugality. Okay.
where management is careful with expenses
Right.
and avoids that lavish spending.
So like no private jet.
No private jets.
Okay, I like it.
There's this great anecdote about marathon analysts looking for CEOs who take the subway instead of limousines.
I love that. That's a great anecdote.
It might seem trivial,
Yeah.
but it speaks volumes about their priorities.
I agree. Totally.
Yeah.
Okay, so we've covered capital cycles.
Yes.
Investor psychology,
Right.
the role of Wall Street,
Mm-hmm.
the importance of management.
Yes.
This is a lot.
It is a lot to digest, but it's fascinating, isn't it?
It is. It is.
You start to see how all these pieces fit together
Yeah.
to form this framework for making smarter investment decisions.
Yeah, absolutely. But before we like wrap up this part of our deep dive,
Okay.
I want to touch on like a giant in the room,
Okay, who is that?
China.
Ah, yeah.
Its economy has been on a tear for years.
It has.
It's attracting massive amounts of capital.
Yes.
What's Marathon's take on China's potential?
That's a great question.
Yeah.
And it's one that takes us into potentially controversial territory.
Okay.
So while many see China as this land of opportunity,
Right.
Marathon has actually historically been quite skeptical.
Oh, really? Why is that?
Their concern stems from the sheer scale of investment pouring into China,
Mm-hmm.
much of it directed by state-controlled enterprises.
Okay.
And they see a high risk of misallocated capital,
Right.
leading to excess capacity and ultimately disappointing returns.
So while the headline growth numbers might look impressive,
Yeah,
there could be some trouble brewing beneath the surface.
exactly.
Nice.
Marathon points to several industries,
Okay.
from steel to shipbuilding,
Mhm.
where massive investments have created a glut of supply.
Right.
And this puts downward pressure on prices and profits,
Right.
setting the stage for a potential bust.
So it's like they're building ghost cities.
Yeah.
And factories that nobody needs.
That might be a bit of an exaggeration,
Okay.
but it captures the essence of their concern.
Right.
They worry that China's rapid growth has come at the expense of efficiency
Mm-hmm.
and that a reckoning is inevitable.
So classic case of too much money.
Yeah.
Chasing too few good ideas.
Precisely, and this actually brings us to a broader concern that Marathon has been sounding the alarm about for years:
What's that?
the perils of cheap money.
Ah, those historically low interest rates we've all been enjoying.
Yes, enjoying or perhaps suffering from, depending on how you look at it.
Right. Yeah, true.
It's a double-edged sword.
Okay.
While low rates can stimulate the economy in the short term,
Mhm.
they can also distort markets
Okay.
and create what economists call zombie companies.
Zombie companies.
Yes.
What are those?
Think of businesses that are essentially kept alive by those artificially low borrowing costs.
So they're not actually profitable.
They're not truly profitable,
Okay.
but they can limp along,
Yeah.
taking market share from healthier companies
Right.
and preventing industries from consolidating
Right.
and purging that excess capacity.
So it's like a life support system
Yes,
for the corporate world,
it is.
but it's one that's maybe doing more harm than good
Exactly.
in the long run.
In the long run. Marathon argues that this can lead to a lost decade of low growth.
A lost decade.
A lost decade.
Wow.
As resources are trapped in these unproductive enterprises.
Okay. That's a sobering thought.
It is.
So we've got China's investment boom,
Yes.
ultra low interest rates,
Yeah.
and the rise of zombie companies.
Rise of the zombies.
It's starting to paint kind of a gloomy picture.
Well, it's not all doom and gloom.
Yes.
There are still plenty of opportunities out there
Okay.
for investors who understand these dynamics
Mhm.
and who are willing to think independently.
Right.
But to round out our understanding,
Right.
we need to take a look at the other side of the equation.
Okay.
The psychology and motivations of Wall Street.
All right. Let's go there.
And for that, we turn to a rather colorful character named Stanley Chern.
Stanley Chern. That name rings a bell.
He's a fictional character that Marathon created to satirize the world of investment banking.
Okay.
He's brash, he's opportunistic, and he basically embodies all the worst stereotypes about Wall Street greed.
Okay, so is he just like a source of amusement? Or is there like a deeper message here?
Oh, there's definitely a deeper message.
Okay.
While Stanley Churn is meant to be funny, he also represents a very real problem in the financial world.
Okay.
The misaligned incentives that can lead to that short-term thinking and a disregard for long-term value creation.
So we might laugh at his antics,
Yeah.
but he's actually a cautionary tale.
Exactly.
In disguise.
In disguise.
Okay, I like that.
Yeah, I think that's a perfect place to pause for now.
Okay.
We've covered a lot of ground.
We have.
From the basic mechanics of the capital cycle to the complexities of China's economy and the satirical world of Stanley Churn.
I agree. It's a lot to take in.
It is.
But it's been a fascinating journey so far.
It has.
And I'm really eager to see where we go from here.
Me too.
To our listeners, thank you for joining us on this deep dive into the world of capital cycles. Stay tuned for part 2.
Yes.
Where we'll explore Marathon's investment philosophy.
That's right.
And some of the key lessons they've learned over the years.
It's going to be good.
Until then, happy investing.
Happy investing. Welcome back to our deep dives into capital cycles.
Yeah, it's one thing to talk theory, but I'm dying to know how this translates into an actual strategy.
Right.
How do they actually find these golden opportunities?
So their approach is surprisingly straightforward, but that doesn't make it easy.
Right.
Marathon focuses on 2 key phases of the capital cycle.
Okay.
First, they seek out businesses that have high returns that they believe are more sustainable than the market expects.
So they're not just chasing the latest hot stock. They're looking for companies with a real lasting edge.
Exactly. They're searching for those rare gems where high returns aren't just a fluke, but a sign of a truly durable competitive advantage.
Makes sense.
Yeah.
And what about the second phase?
Okay, so phase 2.
What are they looking for there?
This is where it gets even more interesting.
Okay.
And contrarian, Marathon focuses on companies in industries with low returns.
Okay.
The so-called value plays.
Value plays, okay.
Where the market is often underestimating the potential for a turnaround.
So it's kind of like that classic buy low, sell high approach.
There are definitely parallels there that can steer that ship through rough waters. Who can resist that urge to overspend when times are good. And make those tough decisions when things get tight.
So like I said, they're like the Navy SEALs of the corporate world.
Yes.
Yeah.
That's a good analogy.
Okay.
You need that discipline.
But how do you actually spot these exceptional leaders? Is there a secret formula?
No magic formula.
Okay.
But there are patterns they look for. Like one example, they really like companies where management has a lot of skin in the game.
Skin in the game, meaning?
Meaning they own a big chunk of the company themselves.
Okay, so their interests are aligned with the shareholders.
Exactly. If their own wealth is tied to the company's success, they're going to think like owners, not just hired hands.
Incentivized the right way.
Yeah, absolutely.
Okay.
Marathon also scrutinizes executive compensation.
Oh, interesting.
Looking for red flags like excessive pay packages and pooks.
Yeah, so like no golden parachutes, that kind of thing.
That kind of thing, yeah.
Gotcha.
They want CEOs who are focused on building that long-term value, not just enriching themselves.
So looking for that humility again?
Humility, absolutely.
And a genuine commitment to the company.
Yes, that commitment to the company's mission.
Okay, I like that.
Yeah.
So they're really looking at the big picture.
The big picture.
So not just about the bottom line numbers.
Not just the bottom line.
Yeah.
They're also drawn to companies with a culture of frugality.
Okay, frugality.
Where management is careful with expenses and avoids that lavish spending.
No private jets.
No private jets, exactly.
I like it.
You know, there's that anecdote about Marathon analysts looking for CEOs who take the subway instead of limousines.
That's a great anecdote.
It might seem trivial.
Yeah.
But it speaks volumes about their priorities.
I agree. Yeah, totally.
Yeah.
Okay, so they have this framework for identifying promising industries.
Yes.
They know how to evaluate the management, but I'm still a little bit fuzzy on like how they actually build a portfolio.
Okay.
Do they stick to these traditional categories like growth or value?
That's one of the most interesting things about their approach.
Okay.
They don't feel bound by those labels.
So they're not afraid to like mix it up a little bit and invest in companies that maybe don't fit neatly into a box.
Exactly.
Okay.
They believe those labels can be misleading and that it's more important to focus on those underlying dynamics of the capital cycle
Okay.
and the quality of management.
So a company that looks like a value stock based on its financials
Right.
could actually be a growth story waiting to happen
Yes.
if it has the right management team
Yeah.
and is in an industry that's,
Poised for recovery.
poised for recovery, right?
Exactly.
Okay.
Marathon is constantly looking for those mispriced opportunities.
Okay.
Where the market has misjudged a company's true potential.
I see. So they're really playing the long game here.
They are.
It's not about chasing quick profits.
No.
They're looking for investments that can grow steadily over time.
That's the essence of their strategy.
Yeah.
They're not trying to time the market or pick the next hot stock.
Right.
They're seeking out those businesses that can generate consistent returns over years, if not decades.
It's a refreshing perspective.
It is.
In a world that seems obsessed with instant gratification.
Yeah, it requires a level of patience
Right.
and discipline that a lot of investors just don't have.
Yeah, I can see that.
Marathon is willing to hold on to investments for years,
Wow.
even when they hit a rough patch.
Really?
As long as they believe in that long-term thesis.
So they're not just like fair weather friends.
No, they're in it for the long haul.
Okay.
They're planting seeds and waiting for them to grow into mighty oaks.
I like that analogy. That's a good one.
Yeah.
Okay, so we've got this big picture macroeconomic view,
Yeah.
a framework for evaluating industries and management, and kind of a healthy dose of caution about the potential risks of cheap money.
Absolutely.
But we haven't talked much about like specific sectors or industries.
Right.
Are there any areas where they see particularly attractive opportunities
Yeah.
or maybe even red flags?
That's a great question.
Yeah.
And it brings us back to something we discussed earlier,
Mhm.
the dangers of cheap money.
Right.
Marathon has been warning for years that those artificially low interest rates
Right.
can distort markets
Right.
and lead to the rise of those zombie companies.
Yeah, those businesses that are kept afloat by easy credit,
Yep.
but can't actually turn a profit.
Exactly.
Right.
And they see this as a major risk in several industries,
Okay.
particularly those that require lots of capital
Mm-hmm.
and are prone to overcapacity.
So like manufacturing,
Manufacturing,
energy,
yeah.
maybe even real estate.
Real estate, those are definitely areas where they tread carefully. They're concerned that low interest rates are preventing those industries from going through a much-needed consolidation.
Right, because the weaker companies are surviving longer than they should.
Yeah.
And that drags down overall profitability.
Exactly.
That sounds like a recipe for economic stagnation.
It can be. Resources are being misallocated,
Right.
and it's putting a damper on growth.
Right.
So they're worried we're heading towards what they call a Japanification of the Western world.
Japanification.
Yes.
What does that mean?
Low growth, deflation, a corporate landscape littered with zombies.
Oh, okay. So not a good situation.
Not ideal.
Okay.
But they're not saying investors should completely abandon those sectors,
Okay.
but they urge extreme caution.
Gotcha.
They focus on companies with strong balance sheets,
Okay.
those that can weather a potential economic storm
Right.
and come out stronger on the other side.
So they're looking for that margin of safety.
Margin of safety.
The companies that can withstand maybe a period of lower profits,
Yeah.
maybe even some losses.
Exactly. They also emphasize the importance of understanding the regulatory environment
Oh.
because government policies can have
Yeah.
a huge impact on specific industries.
Yeah. Regulations can either create value or destroy it.
Absolutely.
Yeah.
Depending on how they're designed and implemented.
Right. So it really highlights the need for investors to stay informed
Yes.
about the political landscape
Yes.
and how that might affect their portfolio.
Absolutely. Stay informed.
Okay. So we've got this big picture macroeconomic view,
Yeah.
a framework for evaluating industries and management,
Mm-hmm.
and that healthy dose of caution about the potential risks of cheap money.
Absolutely.
That's a lot to take in,
It is.
but I'm starting to see how it all comes together
Yeah.
to form this really coherent investment philosophy.
And that's the key takeaway.
Yeah.
Marathon isn't just throwing darts at a board.
Right.
They have this disciplined, thoughtful approach that's grounded in a deep understanding of how markets work.
Right. And how human behavior influences those markets.
And it's an approach that values patience.
Patience, discipline, a contrarian mindset.
Mm-hmm. Absolutely.
Yeah.
It's something we can all learn from.
Yep.
Whether we're seasoned investors or just starting out.
Doesn't matter.
But before we wrap up our exploration of Marathon's approach,
Okay.
there's one more kind of fascinating aspect I want to delve into.
Okay, what's that?
Their unique perspective on intangible assets.
Intangible assets. Interesting.
And how those create sustainable competitive advantages.
It is fascinating, yeah.
So intangible assets.
Yes.
Those sound kind of elusive.
You do.
What are those exactly?
Think of them as assets that don't have a physical form,
Okay.
but can be incredibly valuable.
Okay, give me some examples.
Things like brands, patents,
Yeah.
intellectual property,
Okay.
even a company's culture or its network of relationships.
So these are kind of like the soft factors
The soft factor.
that are hard to quantify,
Yes.
but can make a huge difference.
In a company's success.
Yeah, Marathon believes that in today's knowledge-based economy, these intangible assets
Yeah.
are becoming even more important,
Yeah.
drivers of profitability.
So it's not just about like who can make the cheapest widget anymore.
Not anymore.
It's about who has the strongest brand,
Right.
the best technology, and the ability to innovate.
They're looking for companies that have built up these strong, intangible assets
Right.
that act as barriers to entry,
Okay.
protecting them from competition,
Okay.
allowing them to generate higher returns.
Like they've got a moat around their business.
A moat, yes.
Yeah, making it hard for rivals to attack.
Exactly. And they see this as a particularly powerful force in certain industries like consumer goods, healthcare, technology, even media.
Okay, so they're not just looking at the traditional financial metrics.
You know.
They're trying to assess the value of these like intangible assets
Yeah.
that can give a company that lasting advantage.
Exactly. And they believe the market often underestimates the value of these assets,
Right.
creating opportunities for those investors who know what to look for.
So it's like they're searching for hidden treasure
Hidden treasure.
that everyone else has overlooked.
They're looking for those companies that have built up this treasure trove of intangible assets
Right.
that can drive profits for years to come.
Okay, this is really fascinating.
It is.
Can you give me some specific examples of intangible assets that Marathon looks for?
Sure. One of the most common is brand recognition.
Okay, brand recognition.
A strong brand can command higher prices, create loyal customers,
Right.
making it much harder for newcomers to compete.
So companies like Coca-Cola, Nike, Apple.
Those are classic examples.
Yeah.
You know, Marathon also looks for companies with strong intellectual property.
Okay.
Like patents or copyrights.
Right.
Which can give them a monopoly in certain markets.
So pharmaceutical companies with like blockbuster drugs.
Yes.
Or tech companies with like groundbreaking inventions.
Exactly.
Right.
They also like companies with extensive distribution networks or unique customer relationships that are hard to replicate.
So like Amazon with its massive logistics network.
Yes, Amazon is a great example.
Yeah.
Or Salesforce with its deep ties to corporate clients.
Perfect examples. Okay.
It's not just about the assets themselves.
Right.
It's about how they're managed and leveraged.
Okay.
Marathon looks for companies that are constantly investing
Right.
in their intangible assets.
So they're not just sitting on their laurels.
No.
Right. They're always innovating.
Investing in R&D, marketing, customer service.
Okay. So they're constantly improving these intangible assets.
Right,
So
exactly.
they're treating their intangible assets like crown jewels.
Like crown jewels, yeah.
Right.
Constantly polishing them, making sure they retain their value.
I love that analogy. Yeah.
Yeah.
Okay. I'm really seeing the power of this concept.
Yeah, it's powerful.
You know, by focusing on these companies with strong intangible assets,
Yes.
Marathon is stacking the deck in their favor.
They are.
They're finding businesses that can thrive,
Yeah.
even in the face of intense competition.
That's the essence of their approach.
Yeah.
They're not just playing defense.
Right.
They're looking for those companies that can go on the offensive, using their intangible assets to capture market share
Okay.
and drive profitable growth.
This is such a fascinating way to think about investing.
It is.
But we've been talking a lot about high-level concepts.
Right.
I'd love to see how they actually apply this framework in the real world.
Okay, I hear you.
Do they have any like specific case studies that they can share?
They do.
Okay.
And I think that's the perfect place to pick up in our next segment.
Okay.
We'll delve into some of Marathon's most successful investments,
I love it.
and we'll see how they use their understanding
Yeah.
of capital cycles, management quality, and intangible assets to generate impressive returns.
Okay. To our listeners, thanks for joining us on this deep dive
Yes, thanks for listening.
into Marathon's investment philosophy.
Absolutely.
Stay tuned for part 3.
That's right.
where we'll explore some real-world examples
We will.
of how they've put these principles into action.
It's going to be great.
Until then, happy investing.
Happy investing.
Welcome back, everybody, to our deep dive
Give them back.
into the world of capital cycles and the amazing Marathon Asset Management.
It's been quite a journey.
It has been. And
Wow.
it's like we're learning a secret language, but for money.
It is. It's like decoding the matrix
Yeah, exactly.
of investing.
So we've laid the groundwork. We've talked about these fascinating industry cycles,
Right.
the crucial role of strong management,
Absolutely.
and those intangible assets,
Yeah.
the stuff you can't touch but can make a company so incredibly valuable.
Those hidden gems.
Yes, exactly.
Powerful stuff.
But now let's get down to business.
All right, let's do it.
Show me the money.
Okay, so Marathon's reports, they're packed with these case studies
Oh, cool.
that showcase how they've used their principles to identify these hidden gems
Okay.
and rack up some impressive returns.
Hit me with a winner. What company really exemplifies their capital cycle approach in action?
One of their standout successes was their investment in Colgate,
Colgate.
the global giant behind those toothpaste smiles and other household products.
Okay, Colgate, that seems like kind of a basic consumer staple. What
Yeah.
makes them so special from a capital cycle perspective?
Well, that's the brilliant part.
Okay.
Marathon recognized that Colgate had built this powerhouse
Okay.
of competitive advantage through their laser focus on building their brand and marketing it relentlessly.
So it's the moat concept again.
Moat, yes.
But this time it's built with marketing muscle.
Marketing muscle, that's a good way to put it.
Okay.
So while most investors saw Colgate as this kind of mature, slow growth company, Marathon saw a business that was constantly pouring profits back into strengthening their brand and pushing into new markets.
So it's not just selling toothpaste, it's building this global brand
Exactly.
that represents trust, quality, innovation.
You nailed it.
Okay.
And Colgate's management was on the same page.
Okay.
They were masters of capital allocation, consistently funneling profits back into marketing, product development, even if it meant taking a hit on short-term earnings.
So they were playing the long game.
The long game.
Building a brand that could last for generations.
Exactly. And Marathon was rewarded handsomely for their foresight.
How so?
Colgate's stock price climbed steadily over the years.
Wow.
Fueled by that steady growth and expanding profit margins.
Okay, that's a great example of how recognizing those intangible assets can lead to those outsized returns.
Yeah.
But I'm curious about their value plays.
Okay.
Those companies that are flying under the radar but have the potential to make a comeback.
They have a fascinating story about their investment in Heineken.
Heineken,
The Dutch brewing giant.
Love their beer.
They saw an industry that was consolidating with the big players squeezing out the little guys.
So classic capital cycle turnaround.
Exactly. Yeah. And Heineken was in a prime position to benefit from that. Strong global brand, solid track record of profitability, a management team that was laser focused on improving efficiency, pushing into new markets.
But why was the market undervaluing them?
That's the question.
What were investors missing?
Well, they got caught up in the short-term noise. There were worries about rising costs, competition from craft breweries, slowing growth in some of those more established markets.
It's a classic case of investors fixating on the headlines instead of the underlying story.
The fundamentals. But Marathon saw a chance to buy a high-quality business at a discount. They had faith in Heineken's management to navigate those challenges and come out on top.
And did their bet pay off?
It did.
Okay, how so?
Heineken's stock price rebounded as they executed their strategy, expanding margins and delivering solid earnings growth.
Wow, so Marathon's patience and their contrarian thinking were vindicated.
They were.
Wow, okay, that's two impressive wins.
2 for 2.
But let's be real.
Okay.
Not every investment is a slam dunk.
Of course not.
I'm sure Marathon has had their share of misses too.
They've hit some bumps along the way.
Okay, so can you share an example of an investment that didn't quite go as planned?
Sure, yeah.
One that comes to mind is
Okay.
their investment in Vestas wind systems.
Okay, Vestas, we talked about them earlier.
We did.
Yeah, the Danish wind turbine maker.
That's right.
So they initially saw Vestas as kind of a value play.
They did?
Right, a company with a great market position.
Yes.
But facing some headwinds.
So an industry experiencing a downturn,
Right.
but with the potential for a comeback.
Exactly. They believed the demand for renewable energy would continue to grow.
Right.
And that Vestas was well positioned to capitalize on that.
But something must have gone wrong. What happened?
The capital cycle turned out to be a lot more turbulent
Oh, okay.
than they anticipated.
Okay.
Competition heated up, prices dropped sharply, Vestas struggled to stay profitable.
So they got the big picture trend right,
Yeah.
but the timing was off.
The timing of the cycle was off,
Okay.
and then they also underestimated the impact of government policies.
Oh, okay.
You know, subsidies for renewable energy were cut back.
So the rules of the game changed.
The rules of the game changed,
Yeah.
making their initial thesis less viable.
It's a good reminder that even with like a deep understanding of the capital cycle,
Yes.
a rigorous process for evaluating companies, there's always an element of risk.
Always an element of risk.
Yeah.
Investing isn't a pure science.
Right.
It's an art.
Yeah.
That requires a blend of analysis, judgment, and a healthy dose of humility.
Well said. I think we've covered a lot of ground here.
I have.
From those nuts and bolts of the capital cycle
Yeah.
to these real-world examples of marathons, wins, and losses.
Absolutely.
It's been quite a journey.
It has.
But before we wrap things up,
Okay.
I want to leave our audience with a final thought-provoking question.
I love it. Hit me.
Okay, so given everything we've learned about the capital cycle, the importance of management,
Right.
the power of these intangible assets,
Yeah.
what question should we be asking ourselves
Right.
before we make an investment?
That's the key question. What are the key takeaways you
Yeah.
should always keep in mind?
Exactly. So for our listeners out there,
Yeah.
think about the industry, the competitive landscape, the long-term sustainability of profits.
Absolutely.
Are there any intangible assets
Yeah. Those moats,
that give the company a real edge?
a real edge. And crucially, does the management team have the skills
Yeah.
and the integrity to allocate capital wisely and build value for shareholders?
Those are such essential questions to ask.
They are.
And remember, investing isn't just about picking stocks. It's about understanding businesses, assessing risks, and making decisions that align with your long-term goals.
Couldn't have said it better myself.
All right. Well, on that note, I think that wraps up our deep dive
It does.
into this amazing world of capital cycles.
It's fascinating, isn't it?
It really is. And thank you to our listeners for joining us.
Yes. Thank you.
We hope you've learned some valuable insights
Absolutely.
and feel inspired to apply them to your own investment journey.
Yeah, go out there and do your research.
Until next time,
Until next time.
happy investing.
Happy investing.